Welcome everyone to this week's edition of Q&A with Taxspeaker. Unique version this week. We're going to have every one of our speakers answer a couple of questions that you guys have presented to us over the year, whether it's live in class or submitted to us online. So I'll start it off. I'm Bob Jennings, as you all know. We'll be followed here today. I've got even an order. Ron Roberson will be second, and then Bill Leonard will answer a couple of questions for us. And we'll go on down the line. I'll just tell you the names of everybody just in case you don't remember. Their faces are all on our website. Mark Mursky will be next. That's Mark Mursky. Jeff, you want to go after Mark or you want to go?
Sure.
Okay, Jeff Milligan. Yeah, everybody's here in the room. Jeff Milligan will be after him, followed by Greg Goodsell, and ending with our own Terry Baker, who's going to talk about a topic that I refuse to talk about. All right, so here you go. Question number one. Bob, is it true that some people can avoid the capital gains tax? Well, you know, not only is it true, it's been true for a number of years. Quick reminder, our capital gains rates in America generally are 0, 15, and 20. The 0% rate is available to anyone who is in the 15% or lower ordinary income tax bracket. And to do that calculation, a married couple filing jointly, this year they get a standard deduction of $24,400, and then they get the 15% bracket caps out somewhere in the mid $50,000 range. So roughly, a married couple filing jointly can have total family income, including the capital gain. If it's less than about $102,000, their capital gain rate is 0. So yes, the answer is it is possible. And again, in order to be at the 0% capital gains rate, you have to have an ordinary rate of 15% or less, in which case your capital gains rate is 0. Second question. This is a good one. I have a Schedule C. I bet I've gotten this 10 times this year. Bob, I have a Schedule C with about $60,000 in profit. One of my friends told me an SEP deposit would actually reduce the QBI deduction. Is that correct? Well, let's examine this just for a second. So I got a Schedule C with $60,000 of profit. You and I know that when we're calculating an SEP, you generally get a 25% SEP deduction, but on a self-employed person, you got to back out that self-employment tax effect. So we essentially use a 20% contribution rate. So on a 60,000 Schedule C, you get a 20% SEP, which is 12 grand. That's going to get my taxable income to 48 grand. However, the 199A regulations on QBI tell us that you have to reduce your qualified income from Schedule C, 60 grand, by the SEP contribution of 12. You'd only get a 20% times $48,000 QBI deduction. Hold on. So because you do have to reduce your self-employed income by an SEP contribution, you're going to lose 20% of the amount of the SEP for the QBI deduction. But there's an easy solution. The solution is as follows. You got an individual making $80,000 or less as self-employment income, put the money in the IRA. Why? If I put money in an IRA, so I made $60,000 on my Schedule C. If I put money in an IRA, my QBI deduction is 20% of 60 grand. But if I'm married, I can put 6 grand in my IRA, 6 grand in my wife or husband's IRA, which is a total of 12, but I retain 20% times 12,000, I retain the $2,400 deduction. My summary then to your question was, hey Bob, if I have a Schedule C, does an SEP reduce QBI deduction? Yes, so to use an IRA.
All right, well, welcome back for phase 2. It's my turn, and I'm here today to talk to you a little bit about opportunity zones. One of the things we had some questions submitted, and one of the questions is that if I have an opportunity fund, so an opportunity fund, just to remind you, an opportunity fund has to be either a partnership or a corporation, one of those two things. If I have an opportunity fund that is a partnership, how many partners do you have to have? Can you do it with 2, or is there some specific number? The rule is on that is that it's any partnership, so bottom line is you have to have at least 2 in order to be an opportunity fund. The next question is that if you are a, let's see here, there's a 180-day time limit. So how does a 180-day time limit work? The way that works is from the time that you incur a capital gain. So what is the date, the occurrence of the capital gain? From that date, it starts a 180-day clock. You have 180 days to invest in an opportunity fund. So within that 180 days, you take the money from the capital gain that you had, and you invest in a partnership or in a corporation, you make that investment within that 180 days. And as long as that partnership or corporation is a qualified opportunity fund, that triggers the tax benefit that you don't have to pay tax. You can defer the tax rather on that capital gain. So that 180-day window is when you put the money in, you have that 180-day span to get that invested. That does not include, the 180 days does not mean that the qualified opportunity fund, the S corporation, the corporation or the partnership, they don't have to have invested that money in a qualified opportunity zone within that time period. So the 180 days is only for determining how long I have to make the investment from my capital gain into the qualified opportunity fund. Another question here, these are mine are pretty straight, pretty easy, so I'm going to do 4 of them actually. One of them is the 1099 dividend with capital gains, does that count? Anything that's taxed as a capital gain qualifies for deferral and for opportunity fund benefits. So the 1099 dividend, if you have capital gain distributions, if you get a K1 with a capital gain included on the K1, any of those qualify. The only thing that's a little bit different or odd for those is that the reinvestment period takes place starting December 31st. So your 180-day clock starts on December 31st, regardless of when the actual gain was occurred. And then the last thing is that the corporation or the partnership, whatever it is, the qualified opportunity fund, do you have to certify that before the investment? The investment to take advantage, the rollover of the capital gains to take advantage of the qualified opportunities zone rules has to be made into a qualified opportunity fund. So that means that the corporation or the partnership has to certify itself as a qualified opportunity fund prior to making the investment, the rollover investment from the capital gain. So there's some general examples and of how we deal with the qualified opportunity funds. And I'm going to turn it over to the next speaker.
Well, hello, my name is Bill Leonard, and I'm the third wheel here that you're going to be listening to today. I've got a couple of questions that oftentimes I get asked in practice and at seminars. One of the first questions I oftentimes get from a client that is going to be perhaps setting up their estate plan is, what is an intentionally defective grantor type trust? And an intentionally defective grantor type trust is a unique estate planning tool. If we take a look at the grantor trust rules, effectively they fall within Internal Revenue Code sections 671 to 678. And even though you're dealing with a very small number of sections of the Internal Revenue Code, you are getting a great deal of information out of them. An intentionally defective grantor type trust is generally an irrevocable trust that is actually taxed for income tax purposes to the grantor. And while that sounds rather unusual, here's how it works. Taxpayer who's getting along in years has a very high net worth. That taxpayer then turns around and establishes an irrevocable trust. Now, when one establishes an irrevocable trust, they essentially are taking the assets and transferring it into the trust irrevocably, which means they can't get those assets back. Oftentimes, gift tax returns are required to be filed. The income that is earned in that intentionally defective grantor type trust is what would normally be taxed to the trust itself or to the individuals receiving the benefit from it. However, because there is a drafting flaw done intentionally in this grantor type trust, where the grantor retains an unacceptable power, the income from that grantor type trust, even though it is being paid to a third party, is taxed to the grantor himself. And you might say, well, why would somebody do that? They give away the asset, but then they're still taxed on the income when they don't get it. It is a wonderful way to reduce the taxpayer's estate. Why? You've given away the asset. When the person dies, effectively, that asset, while it will revert back to their estate, the appreciation on the asset will not be includable. And secondly, you have further depleted the grantor's estate because he has paid all of the income tax on the earnings of that intentionally defective grantor type trust. We have a 1041 class here at Taxspeaker, and I suggest it's a good thing to see. Okay, for those of us that prepare GAAP financial statements, we're going to see a huge change taking place for fiscal years starting after December 15th of 2019. And that is the new lease rules are going to be going into effect. And I'm going to tell you something, when it comes to these new lease rules, they are going to absolutely change financial statements like you've never seen them before. A couple of times I've picked up a balance sheet of an airline, and when you take a look at that balance sheet of an airline, what do you see? It isn't what you see on that balance sheet, it's what you don't see, and that is aircraft. There's no aircraft on the balance sheet, and yet you've got Delta Airlines, United Continental Airlines running tons and tons of planes. Why are there no planes on that balance sheet? For one very good reason. They are all being acquired by means of operating leases. And we know that under generally accepted accounting principles, an operating lease only goes on to the P&L. It never goes on to the balance sheet. Well, guess what? As of periods starting after December 15th of 2019, basically what's happening is the chickens are coming home to roost, because for every lease of more than 12 months that takes place starting after December 15th of 2019, effectively they're all going on to the balance sheet. Now, I know what some of you are saying. You're saying, wait a minute, Bill, in an operating lease, I will never own that asset. It's only on a capital lease where I'll own the asset. Even though you don't own the asset, you have a right to use that asset. And that right to use that asset is an intangible asset that essentially is no different than goodwill or a patent or a copyright. You have the ability to make use of that asset, and you are going to bring it on to the balance sheet, as well as the present value of the future lease payments being made on that operating lease. This is going to turn around and blow a lot of companies out of their banking relationships where they have to maintain certain ratios in order to get loans renewed. For more of this, come and see us in our accounting preparation, compilation, and review course. Thanks a bunch for watching.
Hi, I'm Mark Marsky. I'm speaker number 4, new to Taxspeaker, here to talk a little bit about some Q&A. I'm going to give you an example of a client that came in last week with a couple questions. First question was, I have two parties entering into a partnership. One's going to put $5 million cash into the deal. The other party's going to put real estate into the deal. And the real estate was valued at about $160 million, and there was debt of about $130 million. In addition, that individual had a negative capital account of approximately $30 million. After the contribution, partner A, who contributed the $5 million of cash, was going to guarantee 100% of the debt. So the partner B came to us and asked us the question, what consequences are there going to be for me? And is there anything I need to be aware of? Well, quite a bit, to be honest. Two big issues. The first issue was they were going to end up with debt forgiveness because all the debt was going to move from partner B to partner A. So they're going to have to recapture that negative capital account of $30 million. So they'll have gain of approximately $30 million. In addition, the accountant, there was actually an accounting firm involved who was going to be doing the tax depreciation for them and doing special allocations, wasn't familiar with how to do 704C depreciation. And when you have a cash contributing partner and a property contributing partner, no matter what the dollar amount, you immediately have a complex partnership. And what will happen is 704C is going to require you to use one of three methods. Either the traditional method, traditional with curative, or the remedial method in order to allocate tax depreciation away from the contributing partner to the non-contributing partner. all three topics, all of these topics are covered in the LLCs and Partnerships in Depth, and covers good examples on how to allocate depreciation away from the contributing partner to the non-contributing partner. All right, so the second question that was asked of me is, I'm starting an entity, what should I be? Well, a lot of our clients tend to come to us and ask us this question. We get this regularly. You have a Schedule C, you have someone that's already formed an entity, whether it's a corporation or an LLC. And so the question becomes, what should I form? And to be honest, it starts with legal protection. And that's not something I can give advice on. I am a CPA, I'm an accountant. I don't provide legal advice. So be very careful providing legal advice as to which entity someone should choose, whether it be an LLC, LLP, LP, or a corporation. Once they've made the entity choice decision, then you can go through all the different factors, but don't just think about tax. We need to think beyond tax, because just thinking about the tax issues is very narrow focused. We need to think outside the box. We need to consider other issues, such as the ability to make a 754 election and partnerships. What types of owners are you ever going to have over the life of the entity? That's a pretty important factor. Are you going to have to go out and get venture capital to come into your business? If so, forming an S corporation might be detrimental in the long run, because then you default back to C corp tax. Other factors to consider. Are you going to have international tax treaties involved? In our office, we actually have a lot of inbound transactions, meaning we have outside investment that comes from outside the U.S. into the Chicagoland area. So we have to consider tax treaties. Some tax treaties don't recognize the LLC as a form of doing business, so you have to be creative in your entity choice. Exit strategies. How are you going to break up your partnership or S corp or whatever entity you decide to be? You got to think about what is the long-term goal of the owners. In addition, succession, retirement planning. How much money am I going to put away for retirement? If I keep my compensation or amount subject to SE tax as low as possible, how much can I defer into retirement in the long run? Am I going to ever get Social Security? I know some people think maybe Social Security won't even be there when I retire. That is a consideration. I let my clients choose whether or not they actually believe it will be there in the end. But ultimately, the initial entity choice, I do believe, ends up being a legal decision, which how they are taxed ends up being a combination of multiple factors, many of which we just covered. But if you take the choice of entity course offered by Taxspeaker, we go through all of these in depth, and you can really get a good grasp as to which entity makes sense based on your client's facts.
Hi, this is Jeff Milligan, and we're on location in Salt Lake City, Utah for the speaker meeting. And Bob's asked us to answer a question or two. So my question is going to be a question that came up in tax season with my group, is when does a rental property rise the level of a trade or business as far as the qualified business income deduction? And so when the IRS came out with their safe harbor rules of 250 hours and contemporaneous documentation, we pretty much came to a consensus that that wasn't going to happen with our client base. And so we felt like we needed to come up with some guidelines in our office so that we could decide on a regular and consistent basis what was going to rise the level of a trade or business for rental. So these are some guidelines that we came up with. Always do your own research, but what we concluded doesn't rise the level of a trade or business would, if a rental property doesn't make a profit for 3 of the last 5 years, it's not a trade or business. And for that matter, why would you want it to be? If it's just straight cash rent for a farm ground, we didn't feel like that was regular and continuous enough to rise the level of a trade or business. If a client only has one residential rental property, we didn't feel like that was rising the level of a trade or business, but there are circumstances where it may, so exceptions could apply. Some of the items we felt like does rise to the level of a trade or business. If a farmer's doing a true crop share where they're actually paying expenses for chemicals, fertilizer, and interacting with the farmer on crop, then that rises to the level of a trade or business. If they've got more than one rental, then it may qualify for a trade or business depending on the level of their activity. If it's a commercial rental, we felt like it rose to the level of a trade or business. Otherwise, why would you be involved with commercial rental? And if they have more than one rental, we felt like it rose the level of a trader business. So that's my question for the day, and thank you very much.
Hi, I'm Greg Goodsell with Taxspeaker, and I'm here to answer a couple of questions. I want to follow along to Jeff's question regarding what qualifies as a trader business regarding Schedule E rentals. I get a lot of questions from practitioners and seminar participants that ask, well, wait a minute, what about this 250-hour rule? If I don't have 250 hours involved in a rental, does that mean I can't take the QBI deduction? The answer is absolutely not. The safe harbor, the 250-hour rule, is just a safe harbor. And it's almost impossible to meet if you have one or two rentals that are doing well and there's not a ton of repairs involved. So if you meet the safe rental, great, go for it. Safe rental. Safe harbor, if you meet the safe harbor, great, go for it. But if you don't meet it, doesn't mean that your Schedule E rentals are not going to qualify for that QBI deduction, as Jeff pointed out. And for my second topic, I get this question occasionally about people filing bankruptcy or they have old taxes that we've had to do and they've got old tax debts and they're thinking about filing bankruptcy and they want to know if they can discharge their income taxes in bankruptcy. The answer is maybe. There's a lot of confusion over this issue. The answer is maybe. You have to meet 3 major requirements and a bunch of other requirements. The 3 major requirements are, first of all, we're only talking about income tax. It has to have been at least 3 years from the due date of the return, including extensions. It has to have been at least 2 years since you actually filed the return, and it has to have been at least 240 days since the tax has been assessed. That third requirement gives IRS time to go in and perfect liens and file liens and levies to try to get that tax. There are a bunch of other requirements that you have to file. One word of advice: if you're going to file bankruptcy or you're advising a client on filing bankruptcy for taxes, make sure that they work with a bankruptcy attorney that specializes in the dischargeability of income taxes in bankruptcy. Otherwise, they're going to be making mistakes and that tax may or may not be discharged properly.
Hi, I'm Terry Baker. I'm another of the speakers. Looking forward to getting on the road and seeing people this fall and into the winter. A couple of the questions that I get a lot. First one has to do with Airbnb or VRBO rentals. A lot of participants ask me, don't those just go on a Schedule C because they're a business, because they're Airbnb? My answer to that is, with most things in tax law, it depends. The first one you have to look at, however, is Code Section 1402, which is the self-employment code section. In that particular code section, it specifically excludes the rentals of real property from the self-employment tax. So if you're excluding the rentals of real property, the only differences there, the only reasons you would include rental property on a Schedule C would be if they rise to the level of a hotel, motel, or bed and breakfast. Also, if you look under the rules for vacation homes that are used as a residence but also as a rental, those specifically are excluded from self-employment tax. They always go on the Schedule E. Another reason that a rental would go on the Schedule C, however, is if that rental that you are renting out is a boat, a plane, an RV, something that qualifies as personal property as opposed to real property. The other question that people seem to like to ask me revolves around cost of goods sold in a marijuana business. When you have a marijuana business under 280E, you cannot deduct Section 162 ordinary and necessary business expenses. Instead, you're just looking at cost of goods sold. Well, what does that mean? The first place to look, though it is not authoritarian, is Chief Counsel Memorandum 2015-04011. That's a pretty good explanation of cost of goods sold. Here's the quick topic on cost of goods. If you have a retail or wholesale marijuana business, you are only able to deduct cost of goods, which are the cost of the actual product plus the cost to get the product to where it will be sold, plus your cost to ready it for sale. Those are the only deductible costs. However, if you are a grower, we're actually able to go back and use the inventory absorption rules under the pre-1986 Tax Act. What does that mean? As long as the grower is on a Schedule F and it is accrual, it cannot be a cash basis Schedule F, you can take not only the cost to produce the goods, but also the lighting, the labor to plant and harvest, the soils, any hydroponics that you have. So again, that's what you would look at is the inventory absorption rules, but those are only good if it is the grower on a Schedule F. I look forward to seeing everyone. Thank you.
So now you've gotten to listen to all of the speakers from Taxspeaker. We're happy you had the opportunity. We're happy to give you that opportunity. Of course, we can't give things away for free, so here's the sales spiel that goes with it. Taxspeaker has a series called the Taxspeaker Q&A. We charge $20 a month, and we average somewhere around 40 to 50 questions every month that we answer in this video matter, generally related to tax, occasionally technology, and every now and then on accounting. You can get that by subscribing to it. Go to our website at taxspeaker.com. While you're at it, get the free newsletter and look for the link at the bottom of the homepage referring to the Taxspeaker questions and answers session. We'll be happy to see you. Otherwise, see you around the country from all of us at Taxspeaker. Thanks everyone for watching.